Graduating from college is a great accomplishment, but if you've taken out student loans to get your education, the monthly payments on what can be tens of thousands of dollars in debt kick in after just a few months. As burdensome as these payments can be, there is a potential tax benefit to paying interest on student loans. I'm the Tax Geek, and here is the Student Loan Interest Deduction, oversimplified. The Student Loan Interest Deduction can give those who qualify the ability to reduce their taxable incomes by up to $2,500. This deduction is actually an adjustment, which means you can take it even if you can't itemize deductions. What types of loans qualify as student loans? The loan must be for expenses incurred by you, your spouse, or your dependent at the time you took out the loan. The loan cannot be from a qualified employer retirement plan, such as a 401k. The proceeds of the loan must have been used to pay qualified educational expenses at an eligible educational institution. Qualifying expenses can be tuition and fees, room and board, books, supplies and equipment, and transportation to and from the school. This is a much broader definition of eligible expenses than is used for claiming an education credit. Eligible expenses must be reduced by any tax-free assistance received, such as scholarships and grants, employer-provided educational assistance, or veterans educational assistance. An eligible educational institution is any post-secondary school that participates in the federal financial aid program. Interest on revolving lines of credit, such as credit cards, can be eligible for the deduction if you can prove the charges to the card were entirely for eligible expenses. If the charges are commingled with any non-eligible expenses, none of the interest is deductible. So who can actually take the deduction? First of all, you must be legally obligated to pay the interest on the student loan. If someone who is not obligated to pay the interest on the loan pays the interest on your behalf, you, and not the person who made the payment, get the benefit of the deduction. For example, Samantha took out a student loan for undergraduate school, which she alone is responsible for repaying. For her first year out of college, her mother paid her student loan payments to help her get on her feet after graduation. Since her mother was not responsible for repaying the loan, her payments are considered to be a gift to Samantha and are treated as being paid by Samantha, and thus Samantha claims the student loan interest deduction. You cannot claim the deduction if you are claimed as a dependent by another taxpayer, even if you are legally obligated to pay the interest. And, as with many tax benefits, you cannot deduct student loan interest if you file separately from your spouse. You cannot claim a student loan interest deduction, or can claim only a partial deduction if your modified adjusted gross income exceeds certain thresholds. Here are the thresholds for 2023. These thresholds are adjusted every year for inflation. Your modified adjusted gross income is your adjusted gross income without regard to any potential student loan interest deduction. If your modified adjusted gross income falls within the phaseout range, your deduction reduces proportionally. To see how this works, Elwood is currently making payments on a student loan. During 2023, he paid $1,750 in student loan interest. Without considering any potential student loan interest deduction, his modified adjusted gross income for 2023 was $87,000, which is within the phaseout range for the deduction. To calculate his deduction, Elwood subtracts the low end of the phaseout range from his modified adjusted gross income, which is $87,000 minus $75,000, or $12,000. He then divides this amount by $15,000, yielding 0.8. This is multiplied by the total interest paid to arrive at $1,400, which is then subtracted from the total interest paid to arrive at the deductible amount of interest, which in this case is $350. To actually calculate the amount of interest you can deduct, applying the modified adjusted gross income limits, you can use this worksheet from IRS Publication 970, Tax Benefits for Education. This is what the worksheet looks like for Elwood. The deduction is limited to $2,500 per return, even if both spouses pay interest. In this example, Marvin and Sophia are married. Marvin paid $1,532 in student loan interest on his graduate education loan, and Sophia paid $1,225 in interest on hers. Despite paying $2,757 in student loan interest between the two of them, the maximum Marvin and Sophia can take as a student loan interest deduction is $2,500. Student loan interest is reported on Form 1098-E. This is one of the most straightforward reporting forms there is, with information on the lender and borrower on the left and the amount of qualifying student loan interest paid in box 1. Form 1098E is only required to be issued when more than $600 in student loan interest is received by a lender, although many lenders issue the form for lesser amounts. If you paid less than $600 in interest and you don't receive a 1098E, you can review your statements and total the interest you paid, or request the figure directly from your lender. The amount of eligible interest is then entered on line 21 of page 2 of Schedule 1, and that amount, along with any other adjustments you may have, is totaled and entered on line 10 of Form 1040. Making student loan payments can sometimes be a struggle, but the Student Loan Interest Deduction can help ease the financial burden of those payments a bit. You can find additional information and resources on the deduction linked in the video description. Please like the video if you found it informative and share it with anyone else who could find it useful. To see more videos like this one, the best thing to do is subscribe to the channel. And as always, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.